All right, guys, in this video, the entry model I'm going to show you is one that is a liquidity sweep followed by a break of structure and taking an entry right off the break of structure. Now, this entry model is more aggressive, I would say. This is going to be a trading strategy that I believe will be less accurate, but it could also be a strategy that sometimes will help you catch a move with a little bit better of an entry and potentially get you into a move that you might have otherwise missed. Because sometimes if you're waiting for a fair value gap entry, you will miss the move because it doesn't always come back to fill the fair value gap. Okay, so I'm just giving you the pros and the cons of the different entry models, and you guys will have to back test this. You guys will have to play around with it. I would recommend demo trading these strategies, demo trading these entry models, okay? So you can get a feel for what feels right for you and what makes sense for you. I use it, but it's not my favorite. And the reason that it's not my favorite is because I like having a super high win rate, and the more confirmation for me, the better. But don't get me wrong, it still is based off the same principles and the same concepts. It's just a little bit more of an aggressive entry model that definitely can still work, okay? So, again, I have a red line here at opening bell. We're on the 1 minute time frame. And let's just say we were going to mark up, like what I normally do before open is I'm marking up lows and highs. I mark up low, mark up these highs up here, right? So we'll just mark up like these highs, and then we'll mark up these highs. So here's a wick from a news event that week. We see this down candle, this order block really, so we can mark up that low. This is the 5 minute chart. And you can do this on the 5, the 15, the 1 hour, right? So you can mark that up. We'll just mark those up for now because that's what's close. And then if we need to mark anything up later, we can do that. I guess one more low here that sticks out on the 1 minute now that we've dropped down is right there. So let's just leave this for now, and let's see what we get with price. So boom, market opens up, we drop down, and we sweep liquidity. We also just start chopping around here. What's price going to do? Price, boom, drops all the way down through this liquidity, and this liquidity. So now what we would be waiting for to take a buy would be we would wait for a break of structure. So again, all that is price closing back above a high. Since we're looking for buys, we'd wanted to see it close above a high. If we were looking for sells, we'd want to see it close below a low. So let's just see what we get here. And let's start tracking highs and wait for potential breaks of structure, okay? So right now, the break of structure that we'd be waiting on is actually right here. So this would be the break of structure because this is the most recent high. High, boom, drop down. So until we get bearish candles to form, we don't have any new highs that we can track for right now. So let's just see. Price came up, but it didn't close above, so that's not a break of structure, right? Price came up again. Does it close above? Does it close above? Negative. It doesn't close above. Does not close above right there. Now, this is where, and this is another reason that this is not my favorite strategy, and it's because on days like this where you get a lot of chop, and don't get me wrong, guys, not every day is like this, but sometimes it can become somewhat subjective as to when you're tracking a new high. So like right here, and let's just play this. Let's just play it. Screw it. So let's pretend that this is your high that you're tracking. Then based on this strategy, your entry can either come one off of the close of this break of structure candle. So you could enter right there. And your stop loss would go below the liquidity sweep. So you're still going to be using the same stop loss. You're going to go right below that liquidity sweep. Or if you wanted a little bit better of an entry, after you see this break of structure, you could wait for a pullback to the order block, right? So usually if I'm over 7 points, I'm definitely waiting for a pullback to the order block. And in this case, I would even maybe use the body just because it's still pretty long for a stop loss here, just a little over 5 points. But nonetheless, that's what you would do. And TP1, let's see where we are at right there. Great. This high is a 1 to a little over 1 to 1. And, you know, then maybe I would take a little bit more off here just because this is the most prominent high, unless we really start getting up into here. And if I were to draw a PD array on this range, let's see, we're already like coming up to that equilibrium right here as it is. So this doesn't really help us. It doesn't really help us with that. But if we draw it out to here, then we see that we have another equilibrium right there, right? So you could target that for another take profit as well. Extend this out. And then that could be like either your final TP. And if you really wanted to leave a runner, you could target higher highs, but we'll just leave it like that for now. Let me actually go back and delete that so it's not making our chart dirty. Drop back down to the 1 minute, and then let's just see how this plays out. So boom, playing this out. Price pulls back. Great. Picks up our entry at that order block. And now let's see what we get. Price chopping around. Coming up on our macro. We're actually inside that macro of time right now. So let's just see here. So we got macro of time, which is between 8:50 and 9:10. Just mark this out, okay. 8:50 and 9:10. What does price do during these macros? Usually it runs for liquidity. It runs for liquidity and sets up the next move. So where do we see any liquidity? Right now, we've got liquidity above these highs, which actually just got above this high right here on this candle. But we see highs right here. We see lows down here, and obviously the low, which our stop loss is underneath of. So let's just see here. Price comes down, swept that liquidity. Very close to stop loss. Didn't breach the low, though, if you guys look. Literally right to the tick, right at that low. And we always add spread to our stop loss, by the way, guys. So if your spread is 0.8, points, then you would add 0.8 points to that stop loss so you don't get stopped out right here. Price actually has to go below that price in order to stop you out. Price comes up, chops around again. Boom, take profit one gets hit. Same rules, 50% off. Stop to break even. You've made 0.5%. Don't really care, but we're still inside that macro time, guys. Notice how it took out that lower liquidity. Now it took out this higher liquidity and this liquidity. Can't make this stuff up, guys. Time and price. It works. TP2. Boom. Take another partial. And then goes all the way up to equilibrium. Beautiful. Actually had a nice reaction on that 1 minute. Then let's see if you could have targeted higher highs. Chopped around. Yeah, I mean, looks like that was an amazing final take profit right at that equilibrium. So yeah, that is how you would use this strategy. And as you guys can see, I mean, again, not every day is going to be like this. Some days it'll be much cleaner. Some days you're going to see a stop loss get hit because it's a more aggressive strategy. It really is. Now, let's just look for fun if you could have found a fair value gap entry inside of this macro. So, boom, inside of this macro, 9 o'clock hours right here. Oddly enough, sweep of liquidity. We already knew that we were intending for this to go to the upside because we swept liquidity with the open. And where do we see a fair value gap? On the 1 minute time frame, do we see any bullish fair value gaps? We see a couple. We see one right here. One fair value gap right here. So this could have been your entry right here instead of up here. We see another fair value gap right here, which means your entry could have been here also instead of up here. So kind of the same, to be honest. And then you have one more fair value gap right here. Honestly, there's a little one right here too, but I mean, we're getting too nitty gritty at that point. So anyway, you could have entered here as well. Same as right there. Stop loss goes below this low and then goes. Now, here's one more fair value gap here on the 1 minute that never came back to. You guys see that? So like if you waited and you missed all these fair value gaps, didn't take the break of structure entry, then you would have missed out waiting for this fair value gap. The only other way you would have caught this trade would be, again, break of structure. This was the high right here. High right here. Price closes above it right here. So the only other entry, the two break of structure entries were here and here. Order block entry on the pullback. Fair value gap entry right there. Fair value gap. And then this fair value gap never got pulled back into, so you wouldn't have been able to catch that trade there. Maybe if anything, you enter here, stop loss or entry right there. Stop loss would then be below the 3 candle sequence. So boom, 3 candle sequence just like that. And then again, same story, still targeting the same take profits. You wouldn't be able to use this one anymore because it already got hit, but you could use this one for a 1-to-1 TP1, and then you could partial as price goes up. So guys, hopefully that helps. That is the other entry model, is using the break of structure entry model versus only fair value gaps, but a little bonus training, just throwing in what would happen if you looked at fair value gaps as well. But again, the whole thing that is setting this entire thing up is marking up your areas of buy side and sell side liquidity around the open of New York Stock Exchange, waiting for the run on liquidity, and then finding your trade. So that is how I do it every single day. You wait for the liquidity sweep, and then from that point, look for your break of structure or your fair value gap, whatever you are looking to take that entry from, guys. So that is the other entry model with more to come. Hope you guys are enjoying so far. I'll see you guys in the next one.